Let me be honest with you. A lot of beginners think investing is complicated because the internet makes it look complicated. One person tells you to buy individual stocks. Another tells you to buy 10 ETFs. Another tells you dividends are everything. Another tells you real estate is the only real path. And another person tells you you're already too late, so people freeze. And if that's you, if you've ever looked at investing and thought, why does this feel more confusing than it should? Then this video is for you. Because today, I want to show you the simplest global investing structure. No hype, no noise, no unnecessary complexity, just the logic. And honestly, some of you need to hear this. A lot of people are not failing because investing is impossible. They're failing because nobody explained it to them in the right order. So stay with me here, because by the end of this video, I want you to feel something very simple: clarity. Welcome back, or welcome for the first time. This is GrisiekCapital, and this channel is about building real wealth the boring, disciplined way, with systems, not hype. If you're tired of loud internet advice, trend chasing, hot takes, and financial content that sounds smart but leaves you more confused than before, you're in the right place. This is week 3 of the Global Wealth Foundation. In week 1, we built the mindset. In week 2, we built the beginner investing framework. And today we go one level deeper. Today we talk about funds, ETFs, and diversification, not as buzzwords, but as tools, not as labels to memorize, not as things to repeat so you sound smart, but as real tools that can help a normal person build a durable investing structure. Let me ask you something. When you hear words like ETF, diversification, global exposure, or fund allocation, do those words feel clear to you? Or do they still feel like finance vocabulary that people throw around without properly explaining it? Because if that's where you are, that's fine. That's exactly what we're fixing today. If you want the full roadmap and you want to follow this series step by step, subscribe so you don't miss the next lessons. And if you appreciate calm of structured investing education, leave a like. It helps this series reach the right people, not people looking for hype, not people looking for gambling dressed up as finance, but people who actually want to build something real. Now, before we talk about ETFs, I want to talk about confusion. Because a lot of you are not stuck because you're lazy. You're stuck because you've been given too many disconnected pieces. You hear words like ETF, index fund, S&P 500 global fund, accumulating, distributing to emerging markets, allocation. And after 10 minutes, you're not more informed. You're just more overwhelmed. And I want to say something clearly. Confusion is normal in the beginning. So if you're sitting here thinking, I'm interested in investing, but honestly, I still don't fully get how all these pieces fit together, that is completely normal. A lot of beginners get stuck right here, not because they are incapable, but because they are trying to assemble a puzzle without seeing the picture on the box. And this part matters. Because beginners do not need more noise, they need a map, they need sequence, they need logic. They need someone to say, start here, then understand this, then add that later. Let me ask you something. Have you ever watched 3 finance videos in a row and ended up more confused than before? Have you ever felt that investing sounds simple in theory but messy in practice? Have you ever asked yourself, do I need 1 fund, 3 funds, 10 funds, or 100 stocks? That is where confusion starts to slow people down. And once confusion slows you down, hesitation takes over. Then hesitation becomes delay, and delay becomes years of doing nothing. Stay with me here, because this is not just theory. This is about protecting your future decision-making. If you are confused, you are more likely to overreact, underreact, copy random people, or build something you do not actually understand, and that is dangerous. So the map starts with one question. How do you reduce the chance that one bad decision ruins your progress? That question takes us directly into diversification. But before that, I want to add one more thing. A lot of beginners don't just feel confused by investing, they feel intimidated by it. And honestly, some of you need to hear this. The financial world often makes simple things sound complicated, not because they are complicated, but because complexity sounds impressive. Let me ask you something. Have you ever listened to someone talk about investing and thought, this sounds smart, but I still don't know what I'm actually supposed to do? That happens all the time, because complexity and clarity are not the same thing. A person can use a lot of jargon and still give you no useful structure, and another person can explain the same idea simply and actually help you move forward. Do you see the difference? One gives you performance, the other gives you understanding. And in investing, understanding matters more. Because if you don't understand what you're doing, you will not trust it when markets get difficult. This part matters. If you're new, one of the biggest traps is thinking, if it sounds advanced, it must be better. Not necessarily. Sometimes complexity is insight, but sometimes complexity is just decoration. Too many funds, too many positions, too many themes, too many opinions, too many moving parts, and then what happens? You don't feel stronger, you feel less certain. You start doubting every move, you hesitate, you delay, you keep researching, you keep comparing, and meanwhile time passes. I want you to think about this carefully. The goal is not to build a portfolio that looks impressive in a screenshot. The goal is to build a structure you can understand, trust, and continue through good years and bad years. That changes everything. One approach is about looking sophisticated. The other is about surviving long enough for compounding to matter. And I'm not asking you to be perfect here. I'm asking you to become clear. Because clarity first, complexity later, that is a far better order than the reverse. Once you understand that, this is where the confusion starts to disappear. So let's start with diversification. And I want to explain this in a way that actually sticks. Diversification simply means this: your future should not depend on one outcome. That's it. Let me say that again, because this is one of the most important ideas in investing. Diversification means your future does not depend on one company, one country, one sector, one headline, or one bet. Let me make that even more practical. Imagine two people. The first person puts most of their money into one company because they believe in the story. The second person spreads their money across many companies, many sectors, and multiple regions through a broad fund. Now ask yourself, which person has a better chance of being exactly right? Probably the first one, if they picked perfectly. But which person has a better chance of staying financially functional if they are wrong? Usually the second one. And this is the point. Diversification is not built for your ego. It is built for your uncertainty. If you own one thing, one stock, one sector, one story, your result depends on that one thing being right. If you own many things across industries and regions, your result becomes more stable. Now listen carefully, because this matters. Diversification does not mean you remove all risk. That's impossible. What it does mean is you reduce unnecessary risk. And beginners often confuse those two things. They think, if I diversify, does that mean I give up returns? Not necessarily. What you usually give up is concentration. And concentration can feel exciting until it goes wrong. Let's make this practical. If you buy one company and that company disappoints, your portfolio takes a direct hit. If you own hundreds or thousands of companies, one bad result matters less. So when people say diversification, they are not talking about some abstract finance theory. They're talking about survival. They're talking about staying in the game long enough for compounding to work. And this is what I want you to hear. For a beginner, diversification is not boring. It is protection against your own uncertainty. Because in the beginning, you do not know enough to make concentrated bets with confidence, and that's okay. You do not need to start as an expert. You need to start in a way that is hard to break. Let me ask you something. Do you want to be exactly right once or consistently protected over time? Do you want excitement or durability? Do you want to gamble on one big opinion or build something that survives many mistakes? Because a lot of beginners secretly want concentration for emotional reasons. They want the feeling of, I found the winner. I spotted the opportunity. I got in early. I'm ahead of the crowd. And yes, that sounds exciting. But long-term wealth is usually built more by good structure than by heroic prediction. Can you feel how this changes the whole picture? Because now diversification is no longer just a finance word. Now it becomes a behavior, a way of admitting, I do not know the future with precision, so I will build protection against my own limits. That is maturity. And honestly, that mindset alone can save people years of mistakes. Now let's go one step further, because a lot of beginners ask, what's actually wrong with buying one great stock? And the answer is nothing if you fully understand the risk. The problem is not that a single stock cannot perform well. The problem is that one stock creates concentrated risk. And concentrated risk means one company can decide too much of your future. Think about that carefully. One CEO, one scandal, one bad quarter, one regulation change, one failed product, one industry disruption. And suddenly, a big part of your money is attached to one story. And history has shown this again and again. There were people who believed certain famous companies were untouchable. Some believed Nokia would dominate forever. Some believed General Electric was a permanent giant. Some believed Cisco at the peak of the dot-com era could only keep rising. Some believed banks were always safe, right before financial crises proved otherwise. Some believed certain tech leaders could only go one way. Now stay with me here. I'm not saying these companies are identical. I'm not saying every decline means permanent failure. I'm saying something simpler. When you concentrate heavily, you are making one story matter too much. And even great companies can go through brutal periods. A stock can be a great business and still be a painful investment if you overpay, enter at the wrong time, or simply cannot emotionally survive the volatility. Would your plan survive that? That's the question. Not, could this stock go up? Of course it could. The better question is, if this goes badly, does my overall structure still work? This part matters. Because many beginners think risk means choosing a bad company. But concentrated risk also exists when you choose a good company and make it too large a part of your future. Do you see the difference? Company quality and portfolio construction are not the same thing. You can admire a business, you can like a product, you can respect management, and still say, I do not want this one story to carry too much weight inside my long-term plan. That is a more disciplined way of thinking, and beginners often do this for emotional reasons. They buy a company they know, a company they like, a company that feels familiar, a company everyone online is talking about. But familiarity is not diversification. And liking a company is not the same as building a portfolio. So when we say single stock equals concentrated risk, we are not saying single stocks are evil. We are saying they require more confidence, more knowledge, more emotional stability, and more tolerance for being wrong. And most beginners do not need more fragility. They need more resilience. Ask yourself honestly, if one company dropped 50%, would your plan survive? Would you stay calm, or would you panic? Are you building a portfolio, or are you collecting opinions? Because those are very different things. So now let's talk about ETFs. And I want to explain this simply, really simply. An ETF is a fund that holds a collection of assets and can usually be bought and sold on an exchange like a stock. Now don't let that sentence sound more complicated than it is. What matters is the idea. Instead of buying one company, you buy one wrapper that can contain many companies. So imagine this, you walk into a store, you can buy one apple, Or you can buy a full basket with apples, oranges, bananas, grapes, and more. A single stock is like buying one apple. A diversified ETF is like buying the basket. That's why ETFs became so popular, because they allow ordinary people to buy broad exposure in one simple move. And this is where many of you probably feel relief, because maybe you're not trying to become a stock analyst. Maybe you're not trying to spend every evening reading company reports. Maybe you just want a sane, low-stress, structured way to build long-term wealth. That is exactly why ETFs matter. They are not magic, they are tools. And tools should be judged by how well they solve a problem. So what problem does an ETF solve? It helps you get diversification, simplicity, and efficiency without needing to pick every piece manually. And this is where I want to slow down because this part matters. If you're new, do not rush this. You do not need to memorize jargon. You need to understand function. Ask yourself, what problem is this tool solving for me? Now, very important, not every ETF is automatically good. An ETF is just a vehicle. Some are broad, some are narrow. Some are cheap, some are expensive, some are global, some are concentrated. Some are built for long-term investing. Some are built around trends. So don't treat ETF as a stamp of quality. Treat it as a category. Then ask, what does this ETF actually hold? How diversified is it? What does it cost? What region does it cover? What role would it play in my portfolio? That is how adults think about tools. Not ETF sounds smart, so I buy it. But what job is this ETF doing inside my structure? And honestly, that one question can save beginners from a lot of bad decisions, because a tool is only useful if it fits the job. A hammer is a useful tool, but not for every task. The same goes for ETFs. Some are excellent as a core long-term structure, some are not. So again, the point is not to be impressed by the label. The point is to understand the function. Now let's make ETFs even more real, because sometimes people hear the word fund and it still feels abstract. So let me simplify it further. A fund is not magic. A fund is just a structure that holds underlying assets. That's it. If you look inside a broad equity fund, what do you usually find? You find companies, lots of them. Businesses from different sectors, technology, healthcare, industrials, financials, consumer goods, energy, utilities, communications, and often from different regions too. North America, Europe, Asia, sometimes emerging markets as well, depending on the structure. So when someone buys a broad global ETF, they are not buying one opinion. They are buying exposure to a large part of productive business activity across the world. I want you to think about this carefully. That changes how you should emotionally relate to investing, because instead of obsessing over one headline about one company, you begin to understand that you own a much wider engine. You're not betting your future on one product launch. You're not depending on one CEO interview. You're not waking up every day asking whether one ticker symbol will save you. You're holding a system of businesses. And that is psychologically powerful, because it moves you away from drama and closer to structure. Let me ask you something, which sounds more stable to you? Owning one company you hope keeps winning, or owning a wide collection of businesses that can collectively adapt even if some parts struggle? This is where the confusion starts to disappear. Because once you understand what broad funds actually hold, you stop seeing ETFs as some strange financial gadget. You start seeing them as containers, and then the question becomes, how broad is the container? How expensive is the container? What is actually inside it? And does that match the job I need it to do? For example, a broad global fund and a very narrow thematic ETFs are both ETFs, but they do not play the same role. One may be a strong core holding. The other may be a concentrated side bet. And if you're new, that distinction matters a lot. A lot of beginners get stuck right here. They hear ETF and assume all ETFs are diversified. They are not. Some ETFs hold a huge slice of the global market. Others hold one narrow sector, one theme, one region, sometimes only a small basket of companies. So again, don't ask only, is it an ETF? Ask, what is inside it? Because this is not just about labels. This is about whether the structure supports your future or quietly adds fragility to it. Now let's clear up another beginner confusion. Index funds versus ETFs. Because people use these words almost like they mean the same thing. And sometimes, in practical conversation, they overlap a lot. Here's the simplest way to think about it. An index fund is a fund designed to track an index. An ETF can also track an index. So the real question is not which word sounds better. The real question is, what does the fund track? How does it work? And how accessible is it to you? Many ETFs are index-based. That means they are trying to follow a market index rather than actively pick winners. So if you hear index investing, index fund, index ETF, don't panic. The core idea is still similar. Broad market exposure through a rules-based structure. Now, depending on where you live and what platform you use, you may have easier access to ETFs than to traditional mutual or index funds. That's why for many global beginners, ETFs become the practical tool. And again, I want to speak directly to you here. Don't get trapped in word confusion. A lot of beginners spend too much time asking, wait, is this technically an index fund or an ETF? And not enough time asking, is this diversified, low cost, and aligned with my plan? That is the better question. And for many of you, this should be a relief. Because you do not need to become obsessed with technical vocabulary before you're allowed to begin. You do not need to win a terminology contest. You need to understand the function. If a fund gives you broad market exposure, tracks an index, keeps costs reasonable, and fits your long-term plan, that matters far more than whether someone online uses one label more often than another. Let me ask you something. Have you ever delayed action because you were trying to understand every word perfectly before making one simple decision? A lot of beginners do that. And while learning matters, paralysis is still paralysis. So yes, learn the language, but do not worship the language. Use it to build clarity, not to avoid starting. Now let's talk about something beginners often ignore because it feels small: fees. And this is a mistake. Because in investing, small percentages become big consequences over long periods. You'll often hear the word TER. That stands for total expense ratio. In simple terms, it's the annual cost of holding the fund. And if you're new, I want you to understand something clearly. A high fee does not automatically mean a better product. In fact, for long-term passive investing, unnecessary fees can quietly damage your result. Why? Because fees compound too. People understand that returns compound, but they forget that costs compound as well. Let me make that real with a simple idea. Imagine two similar long-term investors, same discipline, same holding period, same monthly investing habit. But one pays noticeably higher annual costs than the other. At first, the difference looks small. Maybe it doesn't even feel worth caring about. But year after year, that drag keeps taking its share. And not just from the original money, from the future growth that money could have created. That is the hidden part many people miss. This is why a fee difference that looks tiny on paper can turn into a meaningful gap over decades. If you're new, don't rush past this. I'm not telling you to become extreme about decimals. I'm telling you to respect friction, because compounding works best when you stop unnecessary leaks, and fees are one of those leaks. Would you willingly drill a small hole in your own bucket? Probably not. So why ignore long-term costs if a comparable tool exists at a lower price? This is where discipline becomes very quiet. No excitement, no adrenaline, no dramatic moment, just a rational decision that leaves more of the result with you. And that is exactly the kind of boring decision that often matters a lot. You don't need the most expensive looking solution. You need a structure that lets more of the compounding stay with you. Now let's talk about local bias. This is one of the most common blind spots in investing. Local bias means people naturally invest too heavily in what is familiar to them. Their own country, their own region, their own market. Why? Because familiar feels safer. But familiar is not always safer. And I want you to really think about this. If the world's economy is global, if large businesses operate globally, if innovation happens across multiple regions, then why would you automatically want your future concentrated in one place? Now, of course, every investor has preferences, and local exposure is not automatically wrong, but overconcentration in one country can create unnecessary dependence. Political risk, economic stagnation, sector concentration, currency exposure, regional weakness. Global exposure helps reduce this. And again, I'm not saying global means perfect. I'm saying global means broader, and broader usually means more resilient. So ask yourself honestly, am I investing globally because I understand the world is broad? Or am I staying local just because local feels emotionally comfortable? Would you want your entire future tied to one country? Is familiarity guiding your decisions more than logic? Are you building a global structure or a local habit? Because those are not the same thing. Now let's strengthen this with history, because this is not just theory. Markets have given us many examples of what happens when people become too concentrated in one country, one sector, or one story. Let me ask you something. Do you think big markets always lead forever? A lot of people feel that way when they are living through a strong period, but history is more humbling than that. Think about Japan. There was a time when Japan looked dominant, powerful, advanced, unstoppable. And then investors who were heavily concentrated there experienced a very long and painful period after the late 1980s bubble. Now think about the dot-com era. Technology excitement was real, some great businesses existed, but concentration, hype, and unrealistic pricing created enormous damage when the bubble burst. Then think about banks before the global financial crisis. Many people believed major financial institutions were stable by default, and reality reminded everyone that concentration in one sector can hurt far more than expected. And even outside sectors, individual corporate giants have stumbled. Enron collapsed, Lehman collapsed, Nokia lost dominance. Entire market narratives changed. Stay with me here. The lesson is not never invest in technology, or never invest in one region, or never own a strong company. That would be too simplistic. The lesson is this: leadership changes, narratives change, sectors change, countries change. The future rarely belongs exactly to the names people feel most certain about in the moment. This part matters, because when people are new, they often confuse what feels strongest today with what will stay strongest for the next 20 years. Those are not the same thing. So ask yourself honestly, am I building around a timeless principle or around whatever feels dominant right now? Because diversified investing is built on humility. It says, I do not need to predict the exact winner in advance. I want exposure to broad productive activity so I can participate even as leadership changes. Can you feel how much calmer that is? Instead of trying to guess the one future correctly, you create a structure that can keep functioning across many possible futures. And that is one of the deepest reasons diversification matters. So let's finish with a question many beginners are quietly asking: can one fund be enough? And the answer is, for many beginners, yes, one broad, diversified fund can be enough to start. Now listen carefully. I'm not saying one fund is always the perfect solution for every person in every country and every phase of life. What I'm saying is this: beginners often think they need complexity to be serious. They think, I need 5 funds, I need 10 positions, I need sector exposure. I need something advanced. Not necessarily. Sometimes one broad global fund is already doing a lot of the heavy lifting. And for many beginners, simplicity is not weakness, it is an advantage. Let me ask you something. If you had to explain your portfolio to a completely new investor in 2 sentences, could you do it? Because if the answer is no, that may be a sign that your structure is becoming more complex than necessary. And honestly, some of you need to hear this. A simple plan that you trust is often stronger than a clever plan that constantly makes you second-guess yourself. You do not need to earn the right to start simply. You do not need 10 moving parts to be taken seriously. You do not need a complicated allocation just to feel like a real investor. What you need is a structure you can understand in calm periods and stressful periods. Would your plan survive doubt? Would your plan survive boredom? Would your plan survive a market drop? Would your plan survive 2 bad headlines in the same week? Because the plan is only useful if you can actually stay with it. And this is where many people sabotage themselves. They build a portfolio that looks sophisticated on day 1. But by month 3, they are already changing it. Adding things, removing things, reacting, tweaking, second-guessing. That is not structure. That is emotional restlessness wearing a finance costume. A durable, simple structure often wins because it reduces the number of decisions you need to keep making. And fewer unnecessary decisions often means fewer unnecessary mistakes. A simple portfolio that you keep buying for 10 years is stronger than a complicated one you abandon after 6 months. And if you take only one big message from today, let it be this: your investing structure does not need to look advanced. It needs to be durable. So, before we wrap up, let's make this practical, because some of you are listening and thinking, okay, I understand the logic, but what does simple actually look like in real life? Fair question. Let's keep this conceptual and beginner-friendly. A simple beginner structure often starts with the core, not 10 cores, 1 core. A broad, diversified fund that gives wide market exposure. That core may already include many companies across sectors and regions. And if that one fund already gives broad exposure, then a beginner may not need to add extra pieces immediately. This part matters, because many people think they are diversifying when they are actually just duplicating. They buy several funds, but those funds heavily overlap. They think more tickers means more diversification. Not always. Sometimes it just means more clutter. So the first question is not, how many funds do I own? The first question is, what exposure do I already have? Do you see the difference? Number of positions is not the same as quality of structure. Now, over time, some investors may choose to add other elements depending on their goals: country, tax rules, age, risk profile, or time horizon. For example, later on, someone may decide they want some bond exposure, some regional tilt, or other specific adjustments. But beginners often make the mistake of starting with the advanced version before they've even built the base. Stay with me here. The base matters most. If the base is strong, the rest becomes easier to think about. If the base is weak, extra layers often just create more confusion. So a simple starting structure might sound like this. I invest consistently into a broad, diversified long-term fund. I keep costs reasonable. I stay globally aware. I avoid unnecessary complexity. And I repeat the process. That may sound almost too simple. But ask yourself honestly, is the goal to sound advanced or to build real wealth over time? Because those are different goals. And this is where the mindset changes again. You stop trying to look like a market genius. You start behaving like a long-term owner. That is a much more stable identity. A simple structure does not remove all uncertainty, but it can remove a lot of unnecessary confusion. And for a beginner, that is powerful, because clarity creates consistency. And consistency is what gives compounding time to work. So let's bring everything together clearly. Diversification means your future should not depend on one outcome. Single stocks can perform well, but they also create concentrated risk if they carry too much weight. ETFs are not magic. They are tools. And the real question is not whether something is called an ETF. The real question is what it holds, how broad it is, what it costs, and what job it plays in your structure. Index funds and ETFs overlap more than many beginners think, so focus on function, not labels. Fees matter because costs compound, just like returns do. Global exposure matters because familiar does not always mean safer, and local bias can quietly narrow your future. History reminds us that leadership changes, sectors change, dominant stories change, which is exactly why broad diversification matters. And for many beginners, one broad fund can be enough to begin. Let me ask you one final question. Are you trying to build something that looks advanced, or something that actually survives? Because that is the real decision. Now, if you want my beginner global investing checklist, comment checklist. It's designed to help you turn this entire video into a simple decision framework you can actually use. Not hype, not overload, not noise, just clarity. Thanks for spending this time with me. And if you stayed until here, I want to say this clearly. You are already doing something a lot of people never do. You are slowing down enough to build understanding before making random decisions. That matters. This is GrisiekCapital, a place for calm, structured investing education. No hype, no trend chasing, no fake urgency. Just systems that help you build ownership over time. Next week, we go into one of the most important parts of investing: psychology, panic, and what beginners need to understand when markets fall. Because building the portfolio is one thing, knowing how to behave inside it is another. Until then, build ownership, stay patient, think long-term, and ignore the noise. I'll see you in the next one.